Today's spiking inflation and huge debt imbalances look like they're going to force interest rates higher in the coming year. And that could drive a massive rotation of capital out of today's popular sectors and into a host of new ones, creating painful losses for some investors and tremendous gains for others.
If they would take interest rates today to 1.75, which was exactly where it was prior to the pandemic crash, the entire treasury curve outside of a 30-year yield would be inverted. So it's that is just to show how trapped they are today. It's almost insane. If there was ever a time to own tangible assets, that time is today, in our opinion.
Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, welcoming you back for another week of making sense of money and the markets so that you can make better informed decisions about building your wealth. Inflation is becoming a real problem. The latest data shows the CPI, the consumer price inflation rate, at 6.2%. That's higher than anything we've seen in decades, and it's looking less and less transitory like our leaders initially promised us it would be. So we now have inflation spiking at the same time that financial asset prices are at all-time highs. What will happen next? Today, we're being joined by Kevin Smith and Tavi Costa, the Chief Investment Officer and the Portfolio Manager of Crescat Capital, a global macro asset management firm highly respected for the market analysis and excellent data and charts it publishes regularly. They believe the financial markets are about to undergo a great rotation where capital will flow out of today's popular sectors and into a host of new ones, creating painful losses for some investors and massive gains for others. Kevin and Tavi, thanks so much for joining us today.
Thanks for having us. Looking forward.
Thanks, Adam.
All right, guys. Well, look, let's get started with a question I like to ask all my guests to kick off these discussions. What is your current assessment of today's global economy and financial markets? And why don't we start with you there, Kevin?
Okay. Well, really, we see some cross currents developing. On the one hand, we have what we think are truly historic asset bubbles in what we call long duration financial assets, whether it's large cap growth stocks, mega cap tech, fixed income securities, and technology stocks, certainly across the board. But valuations for the broad market, not just tech stocks. At the same time, we have rising inflation, like you alluded to, that is really starting to I think, begin to shock people that it is not, that the transitory doesn't mean what the Fed tried to sell us that it means, that it's actually something that's going to be around for a little bit longer and a little bit higher, if not a lot longer and a lot higher than what people originally were led to believe. That's still a shock that we think is coming and building and going to continue to build. But there is opportunity on the long side of the market in commodity related industries, which we can get into a lot more. But that's the basic setup for the imbalances in the market that we see today.
All right, Tavi, anything you want to add to that?
Sure. I think the issue today, on top of what Kevin said, it has to do with this macro regime change that we're seeing. It is an inflationary environment. It's a place where cost of capital has been rising. We think it's going to be rising significantly from here. It's going to change the leadership of the market in a way. It's going to change the way we prioritize fundamental analysis, which has been thrown out the window for the last decade or so. I think that will change significantly. And to Kevin's point, it's interesting how the market participants that we have today, the younger crowds, they haven't seen any recession and declines in equity markets, or the other part of the crowd which has not experienced an inflationary environment. I think we're about to enter a new phase here in the market that will change quite a lot what the leadership will look like. We think that this great rotation is going to come out of very long duration assets, from even treasury markets to even the tech stocks that have unjustifiable, in our opinion, multiples for what we think or what the market thinks they're going to be delivering as far as free cash flow and other fundamentals. And so we think that rotation is going to come into profitability. And the profitability that we find in the markets has to do with natural resource projects, and mostly in mining companies, in energy companies, and so forth. And so our focus has been on tangible assets, owning companies that will do something with tangible assets. And for us, we've never been with so much conviction on adding so much to a portfolio on the precious metal side. So we can get into that as well. But that's where the grade rotation is coming from. It's really from a cost of capital perspective, making it, changing the whole environment of how we prioritize fundamentals.
All right, great. I am excited to get into those resource plays as we get into the discussion here. But first, I want to dig into this cost of capital. Capital has been ridiculously cheap, right? As the Fed drove interest rates down to basically zero. With money being that cheap, it's been super easy to borrow it. The markets have been flooded with liquidity, largely over the past decade plus. So you guys are saying, look, capital's about to become more expensive. I read your guys' recent research letters. This is just one that I printed out for this discussion. Like I told you earlier, before we started recording, it broke my printer. You guys just have a massive amount of not only just analysis, but these wonderful charts. And I do want to try to speak to as many of the charts from your recent letters as I can. On this topic of cost of capital, you've got these two charts showing the net issuances of both Treasury bills and then Treasury bonds and notes. And I'd like it, Tavi, if maybe you can just continue for a moment on cost of capital and talk to these two charts, because they basically show, if I'm reading them correctly, that the Fed is shifting the mix of or at least the Treasury is shifting the mix of the debt that it has out there. It is now issuing fewer short duration instruments, so it's issuing fewer T-bills, but it's now issuing more longer duration instruments. And the reason why that's important is longer duration bills and notes charge a higher interest rate, right? So the mix of capital, at least of Treasury securities that are out there, is the cost is going up because it's got more of those long duration plays. So if you can just sort of say what I said, but say it smarter.
No, that's exactly right what you said. I mean, it kind of caught me by surprise looking at the total amount of issuances of bonds and notes. Number one, we're seeing unprecedented amounts. Unprecedented is a word that's been used quite a lot, but it truly is. We've seen somewhere close to $600 billion, actually a little bit more than that, just in the last 3 months of issuances of those two types of securities. And those, when you step back and look at throughout history, what is exactly happening is throughout, when you have crises, usually what the government does is they issue a lot of short-term maturity bonds, which are the T-bills in the Treasury market, in order to fund a lot of the stimulus that we see coming out of that. And that is also a way where it's much easier for the market to absorb those securities as they come into flooding into the market. Now, what we're seeing today is that later on, just like in the global financial crisis and coming out of the pandemic, is that we start to transition away from that, and we start seeing those T-bills to start to mature, and then we start seeing a very large issuance of bonds and notes. That's precisely what's going on today. So the average maturity of the overall debt in the government is increasing. It was somewhere close to 72 months right now. We think it's going to surge from here. And so we got to think about the supply and demand factor here, because we know that foreign investors have been decreasing the amount of purchase of treasuries. That has been the case, a trend that has been, I would call it a long-term trend. At the same time, we've seen the Federal Reserve picking up the slack and buying a very larger percentage of that. So the Fed owns about 40% of the overall amount of government debt in the markets right now. now of marketable securities. And so where do we go from here when the Federal Reserve is telling you that they've been, so just in the last 3 months, they issue about $620 billion of bonds and notes. The Fed bought about 35% of that in the last 3 months. And they're telling you they're going to go to zero in 7 to 8 months from now. And meaning they're going to be tapering their purchases from 80 billion a month of treasuries and 40 billion of mortgage securities to zero in June, I believe, of 2022. And who is going to be the buyer? At the same time, we're seeing inflation starting to get out of control. So all those forces are questioning, I would say, to us. The real question is, what is that going to do to 10-year yields? We think 10-year yields are very mispriced. We think it's very plausible to see them going up to about 2.5% to 3%. And from there, I think we're going to start seeing this narrative of yield curve control again. So it's, I think it's all tied up to this idea of cost of capital, but it really starts from the government level as well.
All right, thank you. And just to help folks understand why cost of capital is so important, it's important for a whole host of reasons, but the way in which you value an investment, there are several different ways you can do it, but one is doing what's called a discounted cash flow model, where you're basically projecting out how much that particular investment is going to be earning every year going forward. And because $1 today is worth more than $1 tomorrow based on time value of money, you have to come up with what's called a weighted average cost of capital figure to basically use to discount those future cash flows with. And so if the cost of capital goes up, then the ultimate valuation that you're calculating over that time period must come down. It's just a mathematical relationship here. So what Tavi just said is, if the 10-year basically doubles from here, right? Because or goes up by about 50% from here, right? Because it's about 2% right now. It goes up to say 3 or more. That's going to have a really meaningful impact on all sorts of asset valuations. Kevin, heading over to you around this, this situation of Tavi mentioned that the Treasury changing its mix, and the Fed owns a bunch of Treasury instruments, but is not going to be buying them as much going forward or at all once it's done tapering. You guys have said that the Fed has always been trapped, but this time it's as trapped as it could possibly be. Can you elaborate on why you're saying that around this topic?
Sure. First of all, that's probably a Tavi quote, but I agree 100%. So, the idea of the Fed being trapped is really that now we really do have inflation. A lot of people thought there was going to be inflation coming out of the global financial crisis because of all the money printing. I was one of them, and what we had, despite all the money printing, was inflation of asset bubbles. Well, today, and so the Fed could get away with the money printing and the interest rates suppression. We call it financial repression when there's so much debt that the government's able to keep interest rates low they have to keep interest rates low in order to service the debt. But and so that there was an excuse that the Fed had for that for keeping interest rates low and for the QE, because they could get, not an excuse so much as that the idea that they could get away with it because inflation wasn't a problem, and people believed that we were actually in a deflationary economy, and I wouldn't call it deflation, I would call it low inflation, but today things are different. Today we actually have substantially rising inflation, and so the Fed has to do something credible to fight inflation. That's why they're being forced to taper now, and that means no more QE, or a declining amount of QE until the taper is done, and which is June of 2022 according to the schedule now. But even the St. Louis Fed President Bullard was on today suggesting that maybe they need to taper even faster than that to really get ahead of inflation here. And so the idea that they have to do something credible to try to get ahead of rising inflation means that they can't just do this QE and get away with the idea that it's not inflationary, because we live in an inflationary world today, and as Tavi was just saying, that means there's going to be pressure on the long end of the curve. There's going to be pressure on cost of capital to rise, and rising cost of capital is not just the 10-year yield rising, it's also credit spreads rising. Now, when you look at a discounted free cash flow model that they teach us in business school and in the CFA program, it's not, you don't just discount your cash flows by the 10-year yield, you have to also factor in a risk premium. And so I think there's just a lot of kookiness in the market today when it comes to valuations, and people just assuming that you can use ultra low discount rates. But in a rising inflation environment, your cost of capital, your discount rate has got to go up. And especially these long, this terminal, this terminal discounting of growth stocks at a really low rate. When you run your DCF models in a rising inflation environment, you're putting more weight on the front end cash flows than you are on the back end cash flows. And so companies that are actually showing high growth today in a rising inflationary environment become more valuable than the companies that might be showing longer term growth. The companies with the lowest valuations and the highest growth rates actually turn out to be a lot of the resource-based industries today, not the high-tech companies.
Right. The mining company that's profitably pulling ore out of the ground versus, say, a Rivian that has all of its sales in the future. None of it so far today. All right. Exactly. I want to get wonky for a second, but to stick on this point for a second. Kevin, I'd love it if you could talk briefly about this chart here, the Taylor rule to Fed funds rate spread. Because I think it goes to the point of the trap that the Fed is in. What you guys have said here, today's interest rates policy is perhaps the most aggressive interest policy we've ever seen. Considering where GDP growth, inflation, and the unemployment rate is today, the Taylor rule baseline model suggests that the Fed funds rate should be at 9.3%. So am I interpreting that right as saying, hey, sort of in a sane world, that's where the Fed funds rate would be right now based upon historical relationships, but the Fed can't let it get there because the world is so addicted to these low interest rates, it'll just kill the market and plunge the economy into recession if it hikes much higher from here, despite the jawboning that folks like Bullard are doing today.
Sure. Well, first of all, I have to give credit to Tavi for that chart because that's his chart, and it's a brilliant chart because it really shows that when the Fed is doing something credible to fight inflation, and they have to follow rules in order to do that. That's why the Taylor rule came into effect. Was a mathematical formula based on unemployment and inflation. And the trade-off between the two, that to come up with a credible Fed policy for fighting inflation in a rising inflation environment, or for lowering rates in an environment where the Fed might need to do that as well because of high unemployment, let's say. But anyway, I would defer a little bit to Tavi to comment on this chart since that's his.
Okay, yeah. I think that it goes back to the idea, and thanks, Kevin. I'll say that it goes back to the idea of why the Federal Reserve is really trapped. I think that's what's the really meaningful about the chart. It has to do with the capability of the Fed and how restricted they are, and not only the Fed, but really central banks from especially developed economies that are way behind the curve in regards to where inflationary forces are, and we think that financial conditions should be tightening significantly from here, given where inflation is. But the issue is the amount of leverage in the system doesn't allow them to do so. And the other issue is the imbalances in valuations that Kevin was referring to, which I think it's a huge deal. And so when we compare with other decades in the past, and in that chart, we're going back, I believe we'll go back all the way to the 70s. And even that is today is even more extreme. the difference of that is that the government debt in those periods were way significantly lower than what it is today. And some people like to use the 40s as a great example. The 40s, we had that sort of financial repression moment throughout the whole decade where I would say 10-year yields and 3-month yields were actually significantly low compared to where the government debt was. And also where inflation was at the time. So real rates were negative, and that was one of the similarities among those two decades. You can also look at the 1910s, which was another inflationary environment. And those 3 decades have one similarity, which is real rates being negative and commodities outperforming other assets. And so why is this so important? Because I think when you go back to those times, the financial repression we saw in the 40s, we didn't have the tax policy we have today. The tax policy at the time, just looking at the tax bracket of the higher rate of the tax bracket here today, was somewhere about 94%, I believe. Today is somewhere close to 30 or so. So significantly lower than it was. So it's way more aggressive. The other issue that we didn't see back then, which allowed the Federal Reserve to even be a little bit more aggressive than today, or less restricted to what it is today, has to do with the valuations of the equity markets. In the 40s, the valuations were nowhere close to where they are today, not even in the 70s or the 1910s. And so this issue of central banks not being able to use their policies from interest rates, especially to fight inflation, is a big deal. Instead, what we're seeing is policymakers are using double-digit twin deficits relative to GDP. They're going to do another $400 billion of QE in the next 8 months. They're going to keep rates at zero for the foreseeable future. And at the same time, we're seeing ESG policies restricting companies from exploring, developing, and producing commodities. So this whole mix is certainly extremely inflationary in our opinion. And so that is why we think this is a macro regime change. And so that is the relevance of looking at that chart, just a normal model of where you think a model would suggest you to for interest rates to be today. So by the way, just a quick point, if they would take interest rates today to 1.75, which was exactly where it was prior to the pandemic crash, the entire treasury curve outside of a 30-year yield would be inverted. So it's that is just to show how trapped they are today. It's almost insane. If there was ever a time to own tangible assets, that time is today, in our opinion.
Great hard-hitting takeaway there. I'm going to probably use that as the teaser for this video when we go live with it. All right, so Tavi, and then Kevin, I'll go straight back to you with the same question. So you guys are forecasting this future of rising interest rates here. So what do you project as the implication of those higher rates? And how quickly do you expect them to start actually materializing? But when I say implications, do you mean, could this be the pin that pricks the asset price bubble and we have a major market correction? Economic growth is already slowing. Does this throw the economy into recession? Do you see something else? But what do you see as a future living under these higher interest rates looking like?
Can I defer this question to Kevin, because he came up with this term, great rotation. I think it fits perfectly with your question. So Kevin, take it away.
Sure. We think that, the pressure for interest rates to rise comes first and foremost from rising inflation and then from the marketplace at large, the debt imbalances that we have. So yeah, we came up with this concept of the great rotation, which is really this rotation out of overvalued assets that are overpriced due to this assumption of a low inflation economy and a low interest rate economy. But as people start to realize that there's greater return to be had, greater growth, better valuation in the undervalued commodity segments of the economy that have better fundamentals today, this rotation starts to develop. And that people are self-interested and they care about protecting their capital. There's a combination of fear and greed at work here, whether people are trying to make money or whether people are just trying to protect their nest egg. ultimately it becomes a self-fulfilling prophecy that people will want to be in the asset classes that are going to offer the greatest growth and the greatest protection of their assets. And so as commodity prices start to rise, as inflation starts to become higher, it becomes this reflexive phenomenon. In other words, a self-reinforcing kind of phenomenon that leads to this great rotation idea. And we have such overvalued asset bubbles in large cap growth stocks, in mega cap tech, in fixed income securities, that it's a big crowd of investors trying to get through a much narrower door of investment opportunities today, that you can see that it could be explosive in terms of the commodity price boom that we see ahead, and this all feeds into a market that has seen a lack of capital investment going into the basic resource industries in our economy, whether it's metals and mining or oil and gas, or agricultural industries, forest products, the things that we need for the new infrastructure program are not in as abundant as supply as we would like, including the idea of the transition to the new green economy. But to transition to a new green economy, we need base metals, we need precious metals, we need the resources that will allow us to make electric vehicles and solar panels and wind, and that requires a lot of the basic resources that we've just underinvested in. And so we're really looking to this transition economy, and it's a reflexive phenomenon, a self-reinforcing phenomenon as it starts to play out.
Okay, great. We have a lot of hard asset, tangible asset investors in our viewership here, and I think they're listening to you, Kevin, and saying, hallelujah. Like, we've sort of suffered through this kind of lackluster decade. Certainly the precious metals folks, especially if they were in the mining companies, they've got their scars from this past decade to prove what a tough time it's been. And it sounds like you're saying all the reasons why you guys got into hard assets are about to come true. They're about to become fully expressed as all of this capital begins leaving the high-flying, terribly overpriced stocks right now, where fundamentals haven't mattered for years, and it's going to start trying to seek the haven of these smaller, shorter duration, natural resource based plays. And as you said, the order of magnitude of those markets right now is at a huge imbalance. Right, there's just a lot more capital in the Amazons, Googles, Apples, Teslas of the world than there are in these small natural producers and extraction companies. I'll let you provide more detail on that. But real quickly, I just want to dial through a couple of charts from your most recent research letter, which was titled The Great Rotation. You mentioned you expect to see a rotation out of growth and into value. And you have this chart here. Doesn't necessarily look like that rotation has started in earnest yet, but it certainly looks like we are perched at the apex of the trend. And we can see that we saw something similar back around the turn of the millennium, where we were at similar heights in terms of the index rating. And then it reversed pretty deeply over the next 10 years. I assume you expect to see a very similar trajectory, maybe one that even goes deeper than the 2005 to 2009 period. Is that true, Kevin?
Well, asset bubbles burst, and we have one heck of an asset bubble right now in technology stocks, very similar to the tech bubble in 2000. But you're probably referring to the EV to sales chart in there. If you look at other measures, price to book, and free cash flow yield, especially real free cash flow yield. We are at truly record asset bubbles, and we have probably 10 different valuation indicators that we look at that show that the market is the most overvalued it's ever been, the stock market on a broad basis, but especially due to the technology sector, and this is asset bubbles do burst. Markets are cyclical. Yes, we've been in one of the longest growth stock environments ever. If you do have to kind of put that COVID crash aside because it recovered so quickly to new highs here. But if that aside, we are in the longest, most excessive bull market for technology stocks ever. And what is why do these cycles happen? There's two major cycles that we look to for comparison. There's more, but there's two that at least personally I think, and Tavi alluded to one of them, the 1970s are the model for the current environment. In the 1970s, you had the Nifty 50 growth stock phenomenon, and that led to the 73, 74 bear market. This was another negative real interest rate environment like we have today, where you had rising gold prices, rising treasury prices, rising treasury yields, rising energy prices, rising inflation, stagflationary environment that is not unlike today. And the tech bust was something similar, where we just had such excessive speculation in technology stocks. I think crypto is akin to the dot-com bubble on steroids. For me, it's a software kind of a phenomenon. Software is one of the industry groups that we think is just hyper overvalued, and crypto being the software-based technology to me is an extension of that. I know that a lot of the crypto crowd has this very dogmatic view that Bitcoin, for instance, is for inflation protection, and they agree with a lot of what the hard asset investor community agrees with in terms of the need for inflation protection, which we totally agree with here. But it's not a tangible asset in a traditional sense. So I think it's a symptom of the bubble today, and bubbles burst. So that's something that I think we forget about in today's environment. Like Tavi was saying, a lot of people haven't lived through the tech bust or the global financial crisis that are managing money today. Certainly the 1929 style and 73, 74, markets that we, people don't realize that the type of shocks that we can have in the financial market. So are we going to get one of those today? We believe it's a much higher probability than what is priced into the markets today. That's for sure. And that chart that you're referring to is certainly showing that setup today.
Great. Okay, Tavi, I'm going to come to you in a minute because I'm going to want to go deep on precious metals. Before I do, I want to close this out here with Kevin. So Kevin, going through your research letter, and by the way, thank you guys for giving me permission to make that letter available for free to folks watching this video. And folks, I'll tell you how to get that at the end of the video here. It's folks, you should read it. It's phenomenal. It is very thick though, so I'm going to try to do my best to summarize some of your conclusions on this great rotation, Kevin, and you can clarify for me. But you see a big rotation from growth into value, as we just talked about. You say that tech is going to roll over, which you did a great job of explaining why. You do think that the air is going to come out of the speculative crypto prices that are there, not that the blockchain is going to go away, but that the speculation is going to come out of the current pricing. You then think a lot of that capital is going to go into primary resources industries, energy, materials, minings, industrials, et cetera. There are three charts I want to put up here just super quickly to drive a few points home. One is the relative value of commodities to the general market. And you can see here that as a complex, It has, really never been this undervalued. Secondly, I'm going to use oil and gas here as an example, but you mentioned this, Kevin. The industry has been starved of capital expenditures. And so, the resource game is all about production and extraction. But if you're not investing to go find it or to put your discoveries into actual production, you can't actually ship stuff off to the people that turn those raw materials into goods that power the economy. So we've really underinvested in that, as you said. So obviously we're going to need to put a lot more money into that space. And then last, there's a chart here showing how basically comparing the performance of the agriculture ETF to ammonia prices. You can see they're both turning up, but you can see ammonia prices have just skyrocketed. And it's sort of like a preview of what's to come, right? Ammonia is a key input into agriculture. Ammonia prices are taking off. That's going to, in time, ripple through to the agriculture complex. It's going to increase the price of food in general, and those producers are going to have to charge more for it. So we're seeing lots of early signs of what you guys are talking about come to life here. And of course, you guys like the precious metals as well. So Kevin, I'm going to hand it back to you, but did I do a pretty good job of summarizing sort of what you think is going to happen as part of this great rotation, or is there anything else you'd add or clarify there?
Absolutely. I'll let Tavi go into the precious metals as you suggested, but just to comment that it's not just about precious metals. It's about a broad spectrum of commodity prices that have witnessed this underinvestment, whether it's the oil and gas industry, the forest products industry, the energy first and foremost feeds into a whole host of other commodity prices, whether it's metals and mining, whether it's fertilizer. And that's the idea behind the ammonia prices relative to agricultural prices chart. Again, that's a Tavi chart, but a brilliant catch in terms of the relationship between ammonia prices, which are already spiking. Why? Because of rising natural gas prices and the cost of running these plants that produce nitrogen-based fertilizers. Farmers have to buy nitrogen fertilizer every single year to have a crop that year, and they can get by with skimping maybe for every 2 years on the potash and the phosphates, but they have to buy nitrogen-based fertilizer every year if natural gas prices are going up. That's going to feed into the cost of fertilizer. It's going to feed into the cost of food. It's going to squeeze farmers. It's going to drive agricultural prices up. And this is, and so it's a beautiful chart that Tavi showed. Agricultural prices are the next cab on the rank here to come. And it just feeds into this whole wage price spiral, which is people have to eat, people have to heat their homes, and the setup for inflation and commodity prices is something like I don't think we have ever seen before. So this is a big issue.
All right, thanks. Okay, so now let's turn over to the precious metals. We got a lot to talk about there. It's also a topic we talk about a fair amount on this program. I know we have a lot of people that follow it closely, a lot of people that actually own either precious metals or mining companies themselves. So Tavi, just giving you that backstory because folks are really going to be leaning into what we're going to be talking about here. But in your most recent research letter, you guys said that precious metals are, quote, ripe for a major breakout. I'm assuming you're probably going to say some of the same things as Kevin, but any other reasons why you would add to why you think specifically precious metals have such a bright future ahead of them?
I think there's a lot of reasons.
Our interview with Kevin and Tavi continues over in part 2. But before you go listen to it, keep on watching just for one more minute. A lot of this interview is built around the material provided in Crescat Capital's latest research letter, which Kevin and Tavi have kindly agreed to let us offer to you here now for free. To get it, simply go to wealthion.com/Crescat. It's packed with excellent charts and analysis that build on the conversation that Kevin, Tavi, and I are having here. And once you've done that, To watch part 2, just click on the link provided in the description of this video below, or go to youtube.com/Wealthion. But before you do, please don't forget to support this channel by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it if you haven't already. Okay, I'll see you over at part 2 of our video interview with the fund managers of Crescat Capital.